Will silver price continue to plunge? Silver just dropped below $60, and the headlines are calling it a correction. But there's something happening behind closed doors, something central banks are not telling the public. A government deadline, quietly set for July 13th. A stockpile decision. That could change everything. While everyday investors panic and sell, the institutions are doing something very different. So the real question is not whether silver is falling. The real question is, who is buying while everyone else is running? And by the end of this video, you will understand exactly what comes next. Stay with us until the end, because this decision affects every dollar you're holding right now. If you find value in the analysis we bring you today, I would like to ask something of you, respectfully. Something that takes only a moment, but means a great deal to this channel. Please consider subscribing, not because we ask for numbers, but because you deserve to be informed before the next major shift happens, not after. And before we begin, we would love to know, where are you watching from today? Leave the name of your city, your state, or your country in the comments below. This channel is built for people across the world who take their financial future seriously, and we would be honored to know who is sitting on the other side of this screen. Now, let's get into the details. On Monday, June 29th, silver and gold both moved lower again. Silver was sitting at $58.92, down more than 1% on the day. Gold was just above $4,000, also falling. For many casual investors, this looked like just another red day in the market. But for those who study precious metals closely, this drop was not random. It was the result of a very specific chain of events, and understanding that chain is the difference between reacting emotionally and thinking strategically. The first thing serious investors look at is the gold to silver ratio. This number tells them how many ounces of silver it takes to buy 1 ounce of gold. On this day, that ratio stood at 69, edging closer to 70. Historically, when this ratio climbs, it often signals that silver has become undervalued relative to gold. But ratios alone do not move markets. Something else was driving both metals lower, and that something was the United States dollar. Over the past month, the dollar had been getting stronger. It even touched a 1-year high just days earlier. When the dollar strengthens, it almost always puts downward pressure on precious metals, because gold and silver are priced in dollars globally. A stronger dollar means it takes fewer dollars to buy the same ounce of metal, which pushes prices down even if nothing else has changed. So why was the dollar suddenly gaining strength? The answer lies in shifting expectations about interest rates. For months, markets had been pricing in the idea that the Federal Reserve would eventually cut interest rates. But that narrative began to change. Reports surfaced from a major financial institution suggesting the opposite outcome was now more likely. Instead of cuts, the institution projected 3 separate rate hikes, with the first wave expected to begin in September. This was a significant shift in tone. It followed a recent Federal Reserve meeting under newly installed leadership, where officials chose to hold rates steady. But more importantly, they removed language from their official statement that had previously hinted at future rate cuts. To analysts watching closely, this was not a small detail. It was a signal. When a central bank stops talking about cutting rates, markets begin preparing for the opposite. As a result, the dollar strengthened, and another financial institution revised its forecast for the euro downward, expecting a stronger dollar through the rest of the year, due to what they called a more hawkish Federal Reserve. In simple terms, a hawkish Fed means higher interest rates, and higher interest rates make the dollar more attractive to global investors, which in turn weakens demand for non-yielding assets like gold and silver. But markets do not wait for events to happen. They try to predict them in advance. Tools that track rate expectations showed that traders were already preparing for a 25 basis point hike in September. However, looking further ahead, those same tools suggested that by the end of the year, only 1 rate hike was truly expected, not 3. In fact, projections extending more than a year into the future showed traders still betting on just a single hike during that entire period. This created a strange tension in the market. One major institution was forecasting aggressive hikes, while the broader market consensus remained far more conservative. This kind of disagreement between institutional forecasts and market pricing often creates volatility, because every new piece of economic data has the power to swing sentiment sharply in one direction or the other. For business leaders and investors trying to make sense of this, the key takeaway is simple. Silver and gold are not falling because their long-term value has changed. They are falling because of a short-term shift in how traders expect the Federal Reserve to behave in the coming months. This distinction matters enormously. Short-term price pressure driven by interest rate speculation is very different from a fundamental breakdown in the value of precious metals. This raises an important question that every serious investor must now confront. If the Federal Reserve does follow through on this hawkish path, how much further could silver and gold fall in the short term? And more importantly, is this hawkish path even the most likely outcome, or is there a stronger, more dangerous possibility that most investors are not yet prepared for? That possibility comes from a very different and far more controversial voice in the financial world, one who believes the Federal Reserve is heading in the complete opposite direction. And if that voice turns out to be correct, the consequences for gold and silver could be the exact opposite of what most people currently expect. At the end of the previous section, a question was left hanging in the air. If most institutions expect the Federal Reserve to raise interest rates, what happens if a smaller but louder group of analysts turns out to be right instead? What if the Fed is not preparing to hike rates at all, but is quietly being pushed toward the opposite decision? This is where one of the most respected and controversial voices in finance enters the picture. Just days before silver and gold began falling, this analyst posted a warning that received widespread attention. He argued that the longer the Federal Reserve waits to raise rates, the more likely it becomes that their next move will actually be a cut. Not because inflation is improving, he explained, but because inflation will likely keep rising. According to him, if the Fed eventually cuts rates, it will not be to fight inflation. It will be to stimulate a weakening economy, support falling asset prices, or prevent a larger financial crisis from spreading. This argument is built on a simple but powerful idea. Governments and central banks are rarely given a clean choice between good outcomes. Instead, they are often forced to choose between two difficult paths. In an interview given around the same time, this analyst explained the dilemma clearly. If the Federal Reserve refuses to allow more inflation, the alternative is a serious decline across multiple markets at once. Stock prices could fall sharply. Real estate values could drop. A broader financial crisis could begin to unfold. To avoid that kind of pain, governments would be forced into extremely difficult choices, such as deep cuts to government spending or major tax increases on the middle class. According to this analyst, history shows which path leadership usually chooses. He pointed to a long line of previous Federal Reserve chairs, each of whom, when faced with this same uncomfortable choice, ultimately chose inflation over economic pain. He even referenced the recent passing of a former Fed chair who was widely respected for his long career, using this moment to highlight how consistently central bank leadership has avoided allowing painful corrections to fully play out. His conclusion was direct. He believes the newly appointed Fed chair will make the same choice his predecessors made, and that inflation, not economic collapse, will once again be the path chosen. This is an important moment to pause and think clearly, the way any serious business person would when facing conflicting expert opinions. On one side, a major financial institution is forecasting multiple interest rate hikes beginning in just a few months. On the other side, a well-known analyst is arguing the complete opposite, suggesting that rate cuts are far more likely even while inflation remains a serious problem. Both cannot be correct at the same time. This is precisely why this moment matters so much for anyone holding gold, silver, or any asset connected to the value of the dollar. If the hawkish forecast turns out to be correct, and the Federal Reserve does raise rates as expected, then the dollar will likely continue strengthening, and gold and silver could face continued short-term pressure. This would align with what many traditional investors currently expect. However, if the contrarian view proves correct instead, the outcome could be dramatically different. If the Federal Reserve begins cutting rates while inflation is still elevated, this would represent one of the most favorable conditions imaginable for precious metals. Historically, gold and silver perform exceptionally well during periods when inflation is rising, but interest rates are falling, because investors lose confidence in the purchasing power of cash and shift toward assets that protect wealth over time. This is the core tension now sitting at the center of the entire precious metals market. It is not simply a question of whether prices will go up or down in the short term. It is a much deeper question about which version of economic reality is about to unfold. Will the Federal Reserve follow the disciplined, hawkish path that markets currently expect? Or will political and economic pressure eventually force a return to looser monetary policy, regardless of what inflation numbers say? No one, including the most experienced analysts, can say with absolute certainty which path will be taken. But what is clear is that the outcome of this decision will likely define the next major move in gold and silver prices, not just for the coming weeks, but potentially for years to come. And while this larger policy battle continues to unfold in the background, there are several smaller immediate events scheduled in just the coming days that could begin providing early clues about which direction the Federal Reserve is truly leaning toward. While the larger battle between rate hikes and rate cuts continues to play out behind closed doors, business leaders and investors do not have to wait months for clues. Several events scheduled within just the next few days could begin revealing which direction the Federal Reserve is actually leaning toward. For anyone serious about understanding where silver and gold are headed next, this short window of time deserves close attention. The week begins quietly. On the first day, there's no major economic data scheduled for release. Markets are left to digest the previous week's sharp moves in silver and gold, with traders mostly watching currency markets and waiting for the next significant signal. A few smaller reports are expected the following day, but nothing with the weight to shift the broader narrative on its own. The real action begins midweek, when the United States releases its manufacturing data. This single report carries far more importance than its name might suggest. Manufacturing activity is often seen as an early warning sign for the broader economy. When factories slow production, it can signal that businesses expect weaker demand ahead. When manufacturing activity strengthens, it can suggest the economy still has room to absorb higher interest rates without breaking. For the Federal Reserve, this report acts almost like a thermometer, helping policymakers judge whether the economy is healthy enough to handle further tightening or whether it is already showing signs of strain. This matters enormously for the ongoing debate between rate hikes and rate cuts. If manufacturing data comes in stronger than expected, it would support the argument that the Federal Reserve has room to raise rates further, reinforcing the hawkish forecast discussed earlier. A stronger dollar and continued pressure on precious metals could follow. But if manufacturing data comes in weaker than expected, it could quietly support the contrarian view, suggesting that the economy may not be able to withstand much more pressure and that rate cuts could arrive sooner than the market currently expects. Just one day later, an even bigger event arrives. The United States releases its employment report and unemployment rate, two of the most closely watched indicators in the entire financial world. Employment data does more than just describe job numbers. It tells policymakers how much pressure exists within the labor market, and labor market pressure is directly connected to inflation. When employment remains strong and wages continue rising, it often gives the Federal Reserve more confidence to raise rates without fear of damaging the job market. But when employment data weakens, even slightly, it can quickly shift expectations toward rate cuts, as policymakers begin worrying more about protecting jobs than controlling inflation. This single report has the power to move silver and gold prices sharply in either direction within hours of its release. A strong employment report could reinforce dollar strength and add further short-term pressure on precious metals. A weak employment report, on the other hand, could spark a sudden reversal, sending investors rushing back toward gold and silver as a hedge against a slowing economy. By the end of the week, market activity naturally slows. Trading is expected to close early, and the stock market itself remains shut for an upcoming national holiday. This creates a unique situation. Whatever direction silver and gold move during the manufacturing and employment reports, that momentum may carry forward into the holiday period with lighter trading volume, sometimes amplifying price swings rather than calming them. For business leaders, entrepreneurs, and serious investors, the short stretch of days should not be ignored. It represents a real-time test of the two competing forecasts discussed earlier. Will the data support the case for continued rate hikes and further dollar strength? Or will it begin revealing cracks in the economy that support the argument for future rate cuts, even amid persistent inflation? Whatever happens during these few critical days, one thing remains true. Short-term price swings driven by single economic reports are very different from the deeper structural forces that have been quietly building underneath the surface of the silver and gold markets for years. And it is precisely those long-term structural forces, largely ignored by short-term traders, that may ultimately matter far more than any single week of economic data. While short-term traders react to interest rate speculation and weekly economic reports, a much larger and quieter story has been building beneath the surface, one that most casual investors have completely missed. It begins with central banks. According to the World Gold Council, only 1% of central banks around the world currently plan to reduce their gold reserves this year. The remaining 99% are either holding steady or actively buying more. This is not a small detail. Central banks do not make decisions based on short-term price movements. They think in terms of decades, not weeks. When nearly every central bank on Earth refuses to sell gold, it sends a powerful signal about how seriously these institutions view the future value of paper currencies. What makes this even more significant is how much gold central banks have actually been buying compared to what they officially report. Data from the World Gold Council revealed that central banks purchased roughly 15 times more gold than they publicly disclosed. Officially, only 16 tons were reported as purchased in the first quarter of the year. In reality, the true number was closer to 244 tons. This gap between what is reported and what is actually happening suggests that major financial institutions are quietly preparing for something, even while public statements remain calm and measured. Silver tells a similar story, but with an added layer of urgency. Unlike gold, silver is not just a financial asset. It is a critical industrial material used in electronics, solar energy, and national defense technology. Recently, silver was officially added to the list of critical minerals by the United States government. This matters because the country produces only 35 million ounces of silver each year, yet consumes over 215 million ounces annually. This massive gap between domestic production and consumption is the very reason silver earned its place on that critical list. With silver now classified this way, there is growing expectation that the government may begin stockpiling it strategically, similar to how it manages other critical resources tied to national security. An announcement on this matter is expected before the middle of July, and depending on its scale, it could meaningfully shift demand dynamics for silver going forward. Perhaps the most important piece of this entire structural story is the ongoing global silver deficit. For 6 consecutive years now, the world has used significantly more silver than has been mined. This kind of extended shortage is extremely rare among major commodities, and it shows no clear sign of ending in the near future. When demand consistently outpaces supply for this long, it creates underlying pressure that short-term price drops cannot erase. This is why short-term declines, like the recent drop below $60, must be viewed with caution rather than panic. Prices can and do fall in the short term due to currency strength, interest rate speculation, or shifting trader sentiment. But the deeper structural forces, central bank accumulation, industrial demand, national security stockpiling, and persistent supply deficits remain fully intact. For business leaders and serious investors, the lesson here is not about predicting next week's price movement. It is about understanding the difference between short-term noise and long-term structural reality. Markets driven by speculation can be volatile and unpredictable, but markets driven by genuine scarcity, institutional accumulation, and national strategic interest tend to resolve themselves over time, often in ways that punish those who reacted emotionally to short-term fear. The real question now is not whether silver will continue to fall in the coming days. The real question is whether those watching from the sidelines will recognize what is truly happening before the structural shift becomes impossible to ignore.